What if I told you there was a way to make money from your rental property and shrink your tax bill at the same time? Sound too good to be true? Well, in this video, we're going to uncover the best kept secret of investing in real estate. That is real estate depreciation. If you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race, learning about things like depreciation and tax mitigation. Do me a favor and download our free passive income guide below this video. Now, first, let's understand exactly what depreciation is. Depreciation is like a special bonus or gift from the government. That's right, the government actually gives you a gift, and they give it to you when you own property. Depreciation lets you slowly subtract the cost of your rental property from your taxes over time, which is going to help you save money on taxes. Sound good, right? Now, let's dig in a little bit deeper into the concept of depreciation by looking at something called useful life. This is very important to understand when it comes to depreciation. Now, when you own a rental property, all right, let's say you own a rental property, everything inside of it. So if you have all these things inside of it, you got your appliances, you got washer, dryer, countertop, stove, flooring, it's got a door on it, it's got windows, everything inside of this property becomes part of your business. All right. Very important to understand. That means that you can subtract the cost of these items from your taxes over time based on how long they're expected to last. That is this thing called their useful life, how long they're supposed to last. All right. Now, to show my age a little bit, when I was a kid, we weren't like these kids these days that ride around on golf carts or ATVs, side-by-sides. We used something called a bicycle, BMX bikes. Growing up in the 80s, my favorite bikes were a Mongoose, GT Mach 1, Redline, and a Diamondback. Well, their useful life was about 2 to 3 years, even though I wanted one every year when I was a kid. The good old days, right? Now, let's get back to our discussion. So, for example, let's say that you own this rental property and tenants move out, you got some new tenants moving in, and you go in and you paint it. You paint the inside of it. Well, the paint job might only last about a year. So the government says that you can subtract the cost of the paint from your taxes over the course of that 1 year. Different items have different useful lives, and depreciation is all about figuring out how to spread out those costs over time to save you on your taxes. Now, when it comes to depreciation your rental property, you might be wondering, is it better to subtract the cost of each individual item, like the washers, dryers, nuts, bolts, screws, or just make it easy and subtract the cost of the entire property itself? Well, the answer is that it's usually easier to use something called straight line depreciation. All right. This method actually lets you subtract the cost of your entire property over 27 and a half years. If it's a commercial property, it'd be 39 years, but for residential, it's 27 and a half years. That way, you don't have to worry about all the little things that are every little single item that's in your property. All right, let me give you an example. So imagine you bought a residential property, and let's say that you paid, let's make it a big property. Let's say you paid $1 million for it. All right. In this case, let's say that $200,000 is what the cost of the land is. Okay. So $200,000 the cost of the land, and then that leaves you with $800,000 with the cost of the building, right? Now, since you can go ahead and just throw this out. You cannot depreciate the cost of the land, okay? So we're just throw out the $200,000, and then we're just going to focus on the building, or the $800,000 that's for the building itself. Now, using straight line depreciation, you would take the $800,000 and you would divide it by the 27 and a half years, which is going to give you a depreciation deduction of about $29,090 per year over this 27 and a half years. All right, that makes it easy. Again, you don't have to figure out every single item. Take the building, divide it by 27 and a half years, boom, there's your depreciation deduction. Now, but what if you wanted to speed things up? and you wanted to get a bigger tax savings right away, because who wants to wait around 27.5 years to benefit from this, right? Well, there's a way to do that, and it's called accelerated depreciation. And one way to achieve accelerated depreciation is something called a cost segregation study. This allows you to accelerate the depreciation. Now, this study, which is actually performed by an engineering group, the one that I personally use, I'll put the link below this video. This group, it actually lets you, they come in and let you break down, the cost segregation study lets you break down all the items in your property and assign them to the different categories, again, based on their useful life. It's like using a magnifying glass. You're really blowing up the property, using a magnifying glass to look at the property, breaking down its components, and then depreciating each piece based on its useful life. So instead of depreciating everything over 27.5 years, we can now identify items that depreciate much faster over 5, 7, and 15 years with this cost segregation study. Now, this can help you get bigger tax savings in the short term by subtracting the cost of items with shorter useful lives more quickly. So for instance, let's say a portion of electrical system, let's say it costs 50 grand. And let's say it can be written off over, let's say 5 years. Well, guess what? 50,000 divided by 5, that's $10,000, right? So that's going to give us $10,000 in depreciation expense each year for the first 5 years. Now, if you add the accelerated depreciation of other components, and you could be looking at a much higher annual write-off than, again, with straight line depreciation. But with any upside with the government, there's always a downside. So if you sell your property, you're going to have to pay taxes, right? You have to pay taxes on the money that you saved by accelerating the depreciation. A lot of times it's taxed at your regular income tax rates, just like if you had a paycheck from a job. You're also going to have to pay taxes on any depreciation that you didn't accelerate, but this is going to be at a maximum rate of about 25%. This is called unrecaptured depreciation. And finally, any money you make outside of depreciation will be taxed at the capital gains tax rate. All right. So, and it depends on how long you own the property. It could be a short-term or long-term capital gains rate. Anything over, if you own a property over a year, it would be taxed less than if you owned it less than a year. But it's important to be strategic in how you use depreciation, as different methods come with their own benefits and drawbacks. So whether you choose straight line depreciation or accelerated depreciation, always consider your long-term investment goals and consult with a tax professional. I'm not one, don't take this as tax advice. So consult with your own tax professional to ensure that you're making the most of your rental property investments. Now, if you really want to learn more about how you can use real estate to avoid your W-2 taxes, check out this video.